Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest episode of InvesTips from the CIO's desk. My name is Brice and I'm your host for this series. Now we all know that investing comes with risk, and there are several ways to manage risks. The first and most obvious is to diversify your investments across sectors, geographies and asset classes, as this can reduce the volatility of your overall portfolio. But there is a sophisticated approach as well, which is the use of derivatives. Now before we start, it's important to note that derivatives can be used either as tools for speculation or as a way to mitigate risk. Obviously, in today's context, we're talking about the latter use, where they're used to try and manage downside volatility. The obvious analogy to draw is with respect to the weather. Imagine taking an umbrella when the sky is clear. You hope you won't need it, but if it suddenly rains, you'll be glad that you brought it along. In investing, derivatives can work a bit like that umbrella. Naturally, they don't stop markets from falling, but they can help reduce the impact when prices move against you. In other words, derivatives are often used for hedging, which simply means protecting yourself from unwanted financial surprises. So what is a derivative? Well, it's a contract whose value is derived from something else. That can be a stock, an equity market index, a bond, a currency, an interest rate, and even a commodity like corn or oil. And I guess a classic hedging story is as follows. So if you picture a farmer who knows he's going to harvest corn in 6 months' time. Now naturally that farmer worries that corn prices might drop before harvest takes place, reducing both his revenues and profits. So therefore the farmer wants to make a deal today with somebody on the other side, maybe somebody who wants to buy corn in 6 months and therefore worries prices might rise. So they agree on a price today for a transaction in 6 months' time. If prices fall, the farmer is protected, and if prices rise, the other party is protected as well. The key idea, a derivative can help swap uncertainty for some more predictability. Now there are 4 main derivatives when it comes to hedging risks, each with their pros and cons, and it's important to understand these. First, there are forwards. Now this is a custom agreement between 2 parties to buy or sell something later at a price set today. That price is fixed. Because these are often private, over-the-counter deals, there can be more risk that the other side can't or won't fulfill their side of the agreement. So to mitigate that to a significant extent, futures were developed. These are very similar, but they are standardized and traded on an exchange. You usually put down a deposit called margin as collateral, and gains and losses are adjusted frequently. The fact that they trade on an exchange makes them more liquid, and they reduce the risk of non-settlement at the end of the contract. However, margin rules mean that you may need to add money quickly if prices move against you. The reason for this is it limits the exchange risk of you failing to meet your contractual commitments when they become due. The third type of derivative are swaps. So these are agreements to exchange cash flows. So an example here would be interest rate swaps, where you swap a floating interest rate for a fixed interest rate. But you can also have different currencies, so currency swaps, which basically help manage exchange rate uncertainty for both counterparties. And finally, there are things called options. These are interesting because they give you the right, but not the obligation. So in the first 3, you have the obligation, but these give you the right, but not the obligation, to buy or sell at a set price by a certain date. And for that right, you pay a fee called a premium. Now, options can limit downside to that premium, but they still involve risk and complexity. If you buy a put on an equity index, for instance, you are hedging against a broad decline in the equity market, not necessarily the exact exposure that you have, but it does mitigate your risk to a significant extent. So to summarize, derivatives can be used as tools, and used carefully they can help manage risk like an umbrella in bad weather. But used without a clear plan, they can increase risk, especially when leverage is involved. Now, if you're new to investing, focus first on understanding what risk you're trying to reduce and use diversification as the initial defense strategy. However, if you think derivatives can help as well, figure out how much you could lose and what happens in a worst case scenario, and understand the costs and risks of hedging via derivatives. Only when you understand these pros and cons should you act. Thank you for listening today. I hope you found that useful and interesting. I look forward to catching you again soon. In the meantime, please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.